kind of bring everyone together today and sort of talk about Build Wealth and just sort of do like an overview update on everything that's transpired. I'm here today with Mike Brown, Director of Investor Relations. Everyone on this call knows and loves. Mike, how's it going, friend?
All right. How are you?
It's going great. Yeah, going great. Thanks. Listen, we've got kind of a lot to share today, and it's all good stuff. But let's go ahead and just sort of dive in. Okay, let's not beat around the bush. It's the middle of the afternoon. People are at work. We'll get it done. So listen, before we get started, just know that in the webinar, you're going to have a chat and a Q&A at the bottom. Okay. Now, here's the thing. We're going to cover at a high level all 7 funds, as well as introduce an 8th fund that we're announcing today just for you guys as investors. And so as a result, we're not going to allow deep dive or follow-up questions like live Q&A on this call because it's sort of covering everything that's kind of going on, right? And so I feel like if we kind of stopped and went down the rabbit hole of each fund, what would happen is this would be an 8-hour call instead of a hopefully less than 1-hour call. Let's get you through and into it from there. So next slide. So here's the thing. I want to talk a little bit about what it is that we're doing at Build Wealth and why it is that we're doing it. And ultimately, we sort of figure out as we start to find success in our lives that there's still another gap that we have to cross. And ultimately, if you look at the richest people in the world, okay, you've got 8% of people in the United States that have $1 million in net worth or more, okay? But to be in the top 1%, okay, you need to have a net worth of $13 million. I think it's 13.75 right now, a little inflation at play there. And the thing is that ultra high net worth individuals are all the way up here at $30 million, okay? And so the thing is like all of us could get to $30 million in things like the stock market if we were vampires and just lived forever. And instead, our money just doesn't work as hard as we do, okay? And so we are sort of down here, right? We're really working with everyday accredited investors at Build Wealth and bringing to them, more institutional size deals. And so what we're doing is, what I want to bring your attention is when you get to the $20 million mark, guys, you can go to sleep and get to 30 million. Okay. You can go to sleep and get there. And so the journey that I'm trying to take all of us on is how do we bridge from this 1 to 5 million in net worth all the way up to 20 million in net worth? And that's what the types of investments that I'm doing and that we started to build wealth around. Okay. And the concept here is that if you want to try to get there, you have to take control of your financial journey and understand private investments like wealthy people do. Okay. What we do at Build Wealth, what our mission is to bring family office style deals to everyday accredited investors. Okay. And what do I mean by that? Quick review, guys. I'm not going to pound this to death. All of you guys have seen this. This is Tiger 21's asset allocation as a community. It's rumored that their average net worth inside is 50 million. You've got to be 20 million to apply. And ultimately, what you see with their allocation is that you've got 54% of it allocated into private equity and private real estate. Okay, and we've got, and this is all based off of David Swensen and the results that he got at what's now sort of referred to as the Yale endowment model. And he ultimately built a portfolio that looked like this because he was the one that ultimately realized that liquidity in investments was actually very overrated up to a certain level. And that once you hit a certain level, you got better returns by allowing your money to be illiquid, just like entrepreneurs do. Okay. And so ultimately, through his entire career, his 36 years, he got an average annualized return of 13.7%. And he grew his assets of Yale from 1.3 billion to 40 billion during that time frame, a 40x, okay, during that time. And so this is the same style that Tiger 21 and that wealthy people are accessing today. And the way that we do it is we do asset allocation around what we call the wealth stack. Okay, and by doing that, we're looking at private credit, private real estate, and private equity. And these are the things that we offer. But Walker, you wrote the best-selling book in the world on buying small businesses. How does that play into this? Well, look, it's all private markets, buying small businesses and operating small businesses. If that's something that you want to do, obviously I embrace that myself. That is an active role. We all go to work in our job, and then we save our money in the stock market or whatever. And in the private markets, we start or own a business and invest in other private assets with other proven entrepreneurs in those with those playbooks. The other thing I do, guys, listen, just to remind you, everything we do is very heavily diligenced. We're going to talk about AHM. We're going to talk about, Aspen funds. We're going to talk about Mahajer. We're going to talk about all these other partners that we have. I have a former Goldman Sachs VP of real estate, and we go in and ultimately re-underwrite entire portfolios. Okay. We've got a geologist that we've been working with on the new BuildEnergy II fund that we'll be announcing. Let it slip there at the end of this webinar, because the thing is that when I was an LP investor, I came up with a very disciplined approach to investing in the private market back in 2019. And ultimately, what I found was that, when you're writing 50 or $100,000 checks, our access is still kind of limited. I mean, these GPs can't spend a lot of time with us. And so what I do is I find the deals that I want to invest in. I approach the GPs, we do heavy diligence, and then I negotiate family office style terms that gets us as investors, because I'm investing in everything. Mike, I think you're invested in everything if I think about
Yeah.
it. So,
Yeah.
Natalie, you okay? Natalie, we okay?
Yeah, everything is great.
Okay, good. So the thing is that, like, I negotiate deals where all of us get better returns on our dollars, and then Mike and I and the Build Wealth team make a little bit of money for the work that we do by taking their cash, not our LP's cash. Okay, money that would have gone to them as fees. And so, very high level, here is our current projected IRRs for our existing portfolio that we've put together really over a 14-month period. Okay, and as you can see, our internal rate of return is expected to be somewhere between 26 and 35%. All right, compare that to the stock market, which is, we think we're getting 10, but because of volatility and other things, we're getting closer to like 7. Guys, we're getting 7. Okay, this is like a 30. All right, just so you understand where we're putting our money. Okay, and so here's a recent shot of the offsite that me and Mike had with Anna Bowers, who's also on our team. Mike, were we in South Carolina? Were we in
No,
South
it was Valentine, North Carolina,
North Carolina?
right down the
North
street from our
Carolina.
house.
I
Yeah.
don't even know where we were. But anyway, we are just really digging into what it is that we're doing. We're having a lot of fun, and we're building all kinds of strategies and plans for our future as investors. So here's what we're gonna do today. Build Wealth overview. We're gonna review the closed funds and where we are. We're gonna review the open funds and where we are. We're gonna talk about the new fund announcement and just some quick things around what we're looking for in the year ahead. One more thing that I want to share. I think I said this at the beginning, but I just want to re-harp on it. This webinar, okay, is just us. It's just us active investors. This was not an invitation that went out to other people on our list. Everyone on this call has money in our deals, except for 2 people that Constantine invited, and I said they can come. Okay, so welcome, friends. Okay, but I just want you to know that that's what it is that we're doing here. And so here's the thing. It's important that everything that we talk about today is confidential and really just intended for us as shareholders. Okay. In other words, there's going to be things that I'm sharing that aren't really out there yet. And I'm still going to be a little. I'm going to keep the roof on a little bit. But we do things in media, just as an example, that if it gets out that certain IPs are with certain channels or things like this, or we know expected revenue for any of these projects, if that stuff gets out, it actually destroys immense value for us and our assets. Okay, and on the flip side, if there's ever any bad news, you don't want to get that out either, because then all of a sudden bad projects become bad projects. And the truth is that all of these things are always moving forward, and everyone's always working the best that they can. Disclaimer. Whatever, be an adult, forward-looking statements. I can't give financial advice. You might lose all of your money. These are forward-looking projections. I've never seen a projection of any kind that's right ever. Be an adult, all the rest of it. Okay, here's us. I'm Walker. That's Mike. We are your hosts. Here's Build Wealth by the numbers, folks. Here's where we are. We've launched 7 funds, okay, in 16 months, okay? We have over 200 investors. Thank you. Honestly, thank you. We've raised over $30 million in the last 16 months, and we have 33% of our investors are repeat investors investing in more than one fund. Okay, I am just thank you. And so it's one of these where, we are trying to build a community of LP investors where we can build our own family office and go out there and negotiate better deals for ourselves and get better access and better diligence. And again, these are all the places where I'm putting my actual money. I'm putting 7 figures into a lot of these things. So like, this is a heat map of where our investors are. And so, keep this in mind as you begin to think about what we might do in 2026. So check this out. Build Wealth is now one of the largest independent capital raisers in the United States, and I think actually the world. We'll just leave it at that. I could talk on that for a while, but this is fact, okay? So that's fun. Next, I just want to share, I think all of you are subscribed to WealthStack Weekly. This is our new newsletter. It's actually the fastest growing private investing newsletter in the world. And in the last 6 months, we've gone from 0 to over, I think this last issue went out to 106,000 people on 2 days ago, on Tuesday. And so, if you aren't getting that, please make sure to sign up. And the other thing that's great is that if you hate getting emails from me, you can always unsubscribe to WealthStack Weekly and still be getting the investor updates and everything else because they come from different domains. So that's just the beginning of our education effort. Okay. So here, let's review our closed funds. And by the way, every time that you see this big red train, I want you to understand this is the money train. Okay. And this is the money train that we're on. Come on, Mike. Come on. I mean, So, okay, our first one was the Rothschild Portfolio. Now, okay, this was the first one, and it was really pre-Build Wealth, but it was the fund that really started the whole thing. I started with AHM, which is my, I've got my personal real estate team that I've invested more money with, and now I'm joining the partnership and investing $1 million of my own cash into AHM just because the edge, how they do it, all the rest of it, I've talked about them a lot, so I won't do that here. But the Rothschild Portfolio was something where I loved this project. Kyle came to me and said, "Do you want to help us raise?" We had 1,350,000 we had to raise, and I was like, "I'd love to. I love this project. It's great returns. I get it. I know exactly where it is." And we raised $1.35 million, ladies and gentlemen, in 4 hours. And that was the moment that changed the whole trajectory of everything that we were doing. I didn't call Mike that day, but Mike and I found each other over the months ahead, and same with Anna and others that we work with. And HM strategy, again, I'm not going to go through this. I've done a whole presentation on this, but the way that the way that HM approaches the market is very unique, and they get very ingrained in what it is that they're doing. And so, ultimately, this was projected at a 51% IRR, internal rate of return, and we're really on track for 49 right now, and we think we're going to edge it up. We bought in at $90,000 per unit, and we're currently at $250,000 per unit. We have done substantial rehabs, and we are continuing to do that right now. Let's see, we've just got our QCP. We received clearance for that, approval for that last week, and we've got 36 units on one of them fully rehabbed. We have 70% rehabbed at the second one, and the Tudor building is, what did I write here? Sorry, we have 61%. We've renovated 40 of 61 units. Sorry, can't read my own writing. So, renovations continue, and we're switching some of these to into higher rent. And so it's one of these where everything is on track. If you are in this fund and want out, please call me because I will happily buy you out. It's, it's great. Okay, moving on. OK Stone. So OK Stone was obviously the first business that we brought out. And let's see, probably our largest to date. We hit about 7.7 million raised on BuildStone I, and then another 2.3 million on BuildStone II. So we raised about $10 million in this business. And This actually is not a photo of me in Dallas. This is me at Breton in Italy, and this is the polisher. These machines are huge. If you're in this deal, you know that already. But the first production line was completed late last week in Dallas, and they've started testing. So that's a really big update. And so here we go. So we've got product in market because we've been buying blanks from the secondary manufacturing companies. When you start manufacturing, you don't just go to market. You do test markets, and there was two. One was in Italy, one was, I believe, in India, and we bought 100% capacity on those, and we've been able to get product in market made on our same machines, even though it's not our machine in Dallas. So we own global. I'm saying this loosely. Don't go out and repeat this, but we basically own the whole entire technology and product globally. We have a new CEO. Okay, he's in transition. So I've been asked not to share his name, but ultimately he's got 25 years of experience doing exactly this. He's got extensive supply chain management. He's spent stints in marketing with billions of dollars, and he's been working extremely. How should I say? So David Barron was the prior CEO, and he left at the beginning of this year, end of last year. I think I know why. And we won't go into that because I don't want to gossip, and it doesn't matter. The point is like all opportunities, like me and everyone else who manages teams, whenever you lose somebody, you always look for an opportunity to upgrade, and that's exactly what Oren and team has done here. And so we've got a really great CEO coming in who's really been the one driving putting together and assembling the entire manufacturing line in Dallas. And when I had a chance to meet with him, just the level of detail and excitement that he had over, like, water lines or whatever it was like a kid at Christmas. It was really cute. So anyway, he's very competent, great guy, high level of competency there. We have, again, I don't want to mention names. I don't want to do rumors, but we've got those of you that are in the deal know who this is. We've got a big Silicon Valley person on the board who's done extensive tech level IPOs, who is working with Oren and the rest of the board on positioning for the IPO process, which is starting. You might say it's a little delayed, but like ultimately there's saying, Q4 2026, Q1 2027 is now the new target for going public. Okay. And remember, if you're in this deal, going public does not mean when we exit. We're engineering liquidity into the deal so that we can sell once we know that we're going to get to, the projections that we've done, and if not above. We'll get to that in a minute. Look, Oren is hell-bent on generating, proprietary technology. And we are building technology on top of all of Breton's technology, okay, our supplier. But Breton is also developing all kinds of new technology. And ultimately, let's just say that Oren has gone to Breton and said, I want all of your technology and I want an exclusivity around it. And Breton is responding by saying, okay, Stone, you are our number one client, and there's no one else that we'd rather work with on this. So nothing is formally inked, but we have a very high level of cooperation and a very high level of desire to acquire anything that comes out of Breton, as well as developing our own proprietary on top of it. So that is going great. And Breton, actually, I will tell you, just sort of being on the inside, has a newfound commitment for even developing more technology. And so Oren is trying to make sure that he's in the position to buy all of that. We've got 5 salespeople. 2 are inside, 3 are external freelancers. We're focusing on the distributor and fabricator network build out. And, ultimately, we think that, the next phase to that is, ultimately working with architects and getting in at the pre-design level. But this is level 1 of the sales outreach. And so we're building an entire network around this. I just want to note there is a B2 open direct with OK Stone. If you're interested in learning more about this, call Mike Brown on this line right here. It's being offered at a value of $275 million. If you were in our first initial A2 round, we came in at $117.5 million. And the next round is launching in 3 weeks, which is at $325 million valuation. And Why is that significant? I just want to mention that if you were in on our original A2, we're already at like a 2.75x return on our cash right now with, on paper with the, sort of illiquid investment. So, I mean, this is a really nice on track kind of valuation that's moving. Okay. I've been on 2 Italy trips with these guys. You have to be an investor with us in this project in order to go on this trip. Okay, so there's another one the second week in November, and my wife and I are going. And come join us if you're interested. We're going again. Oren will not be there this time. He was supposed to be, and he can't because he's closing deals, which is amazing. And also, if you are on this deal, you have to be an investor. We have upcoming annual shareholder event in Carlsbad at the end of January, and there's a lot of updates and fun to be had by all, including the casino night where Anna Bowers cleaned up on that table. Okay, the 314. Guys, this is the largest mass timber building in the world. Okay, this is a ground up AHM right here in downtown West St. Louis. It's 29 stories, 287 units. Point of order. I just want to jump in here and say one thing. If you're listening to me and you're like, boy, Walker is like really selling me on stuff, I'm just excited, and I have cash invested in all of this. Okay, so if you feel like I'm selling you, it's totally accidental. I'm not trying to sell anyone. We're all investors together, and I just get very excited. So forgive me if you feel like I'm hard selling you or something. Anyway, 29 stories. It's 287 units, 15,000 square feet of retail with a 7th floor high-end restaurant. There's nowhere to take to have a business lunch around this area, and there are a lot of jobs. There's a parking garage. It's 314 feet tall, which is also the area code of St. Louis, which is why it's called the 314. And it's the largest global mass timber project. And it's a $145 million build out. Okay, so this is a very exciting project right in the middle of. Hold on, I think this is a map. Yeah, so this is. Let's see. This is number 11 on this chart here, okay? And just to go up, you see number 10? Number 10 looks like this, and that was actually, it's the building on the left. That's actually the building where they invented Listerine, which I think is really interesting, and AHM's actually putting their headquarters right there on that top floor once that's done. So, this is just an absolutely stunning building. It's based on comps done in, Milwaukee, for example, and AHM had the foresight of buying 11 or 12 or 13 or 14 urban acres in downtown West, right next to the new stadium. Initial timeline is delayed, so this is they're hitting some hangups here. So the vertical mass timber construction significantly changed. So in other words, the way that you build these buildings is you build out all of the projections. Then you raise the money. Then you go out and say, okay, everybody, we have the money. This is actually a go. And then you go out and it takes months to get all of the quotes on all of the stuff. And everything came in higher. And the union labor rates updated to the high side. And so basically the team has been expanding design changes to hit the target budget and also the return profile that we're all expecting to get. I will tell you, I know these guys, I know them well. And one of the reasons why I love to invest with them is I know what they do in bad situations. This team is working relentlessly at no charge to us, okay, on multiple solutions to get this done. They've already reduced the budget by $155,000 per unit, not 100, it's $155,000 per unit. And they're trying to get it down another 95,000. Okay, so I think the big point here is this is a really good example of the risks involved with the private market. This is a great project. Our returns are not at risk at all. Well, I guess everything is always at risk, but the point is like, I'm still absolutely expecting our returns. The timeline's delayed. Like we said at the beginning, I've never seen a projection that's accurate. Sometimes it's faster, sometimes it's longer. And it's all just about, banking the team and the project that's going to get going. And this is, sort of the silver lining of what's happening. Number one, the rest of downtown West, all around, all those other properties are continuing to go. The rehabs are continuing. There's a couple of ground ups right there. The next one is almost fully raised and going. And again, remember, the 314 was supposed to be completed last of the whole neighborhood and be that, most desirable place. We have 15,000 new jobs coming to downtown St. Louis from Boeing, and 5,000 new jobs coming to downtown St. Louis from Nestle. Kyle Howerton, the managing director of AHM, has meetings with both of these companies next week with their head of relocation to continue to push desire into our properties. And the point here, guys, is we have 20,000 new jobs moving to the neighborhood right now. And so as we are figuring out how to get this done, demand is continuing to surge for what it is that we're building, which is always, always, always what I'm looking for when I'm investing, is that supply demand imbalance. Okay. Which gets me to BuildInteractive I. Okay. And for those of you in this deal, you know that it's the 007 James Bond video game. And that is what we're investing in. Except, guess what? It's actually not. Just to be clear, it's very exciting to get really, really excited about the 007 video game because it's awesome and it's expected now. Insider information, we are projecting $300 million in year one just from 007. What we bought into, if you remember, is we actually own the company, the production company Delphi, that got the license for 007 and hired IO Interactive. Okay. We are a video game production company. Okay. And we are a video game production company like never before. There are 3 partners, 2 of which have already grown multiple billion-dollar video game companies, one of which went public. We've got a very unique strategy in the marketplace where we're licensing tier 1 intellectual properties, partnering with the best developers out there, and building world-class AAA games. Okay. This is all about our Delphi bank here is all about licensing the best IP in the world and building video games around it, including 007, which is our first one. The thing that made this deal unique is that I negotiated a deal with them where we get 100% of our money back. Okay. I'm so sorry. We have fees. So there's like 95% of our money back when 007 money comes back to Delphi, which is also in first position in the waterfall. Okay. We're in first position of everybody to get return of our investment, which is completely eliminating our risk. Okay. And then after all of our investors get 100% of their money back, then it's just, whatever Delphi can do. And, we bought in at 275 million, and they are very much going for a $2+ billion exit, or just to be crazy, crazy profitable based on how crazy profitable these games are. But it takes a lot of money. This was a $150 million game. And did I see all this? The First Light trailer launched, which was a 007. It launched, what, Mike? Was that like a month ago, 6 weeks ago? Oh, it was September 4th. Yeah, it was right before September 4th. Yeah. And what happened was on September 4th, First Light was the #1 best-selling video game in the world, and you can't even play it. It's a pre-sale. That's not all. It was the #1 best-selling product on Amazon. If you ask me, Amazon is the largest store ever known to humans in the history of mankind, and it's the #1 seller there, which translates, I believe, to the #1 selling product in the world on September 4th. It's expected to do very well, guys, which will increase the value of Delphi. It assures the return of our capital. We are on track for a March 27th release date. I already bought the game. You can too. I probably bought it on September 4th and didn't know. And we're estimating $300 million in revenue in year one. There is big news coming in the next 2 weeks that I cannot tell you what it is. I can't mention at all that we happen to close a $615 million deal today. And I also can't tell you that we closed a $85 million deal today. So look forward to what those updates might be. But just know that it's all around global franchisable IP, and that's what we're doing. Okay. Okay, so we're gonna move on to our open funds now. Okay, BuildFlow I. Tell you what, we're gonna move to Mike because I can talk all day long, and I don't want you guys to get tired of my voice. So let's move to Mike, and Mike, you can walk through BuildFlow I, and then I'll go through BuildEnergy when you're done.
All right. Can't I share my screen? Yep, here we go.
Okay. Happy to share mine if you have problems. But only if you dryly say slide every time you want me to move forward.
All right, how's that?
Good.
Is that
Perfect.
good? Okay,
Perfect.
perfect.
Yeah, thank you.
All right, awesome. So, I've heard Walker say this many times, and I 100% agree. Our credit fund is our most underrated fund. It's like the little engine that could. It keeps chugging along, compounded monthly, provides better risk-adjusted returns than the traditional markets. And in fact, every time, we get our community is growing so fast, and every time we get a new potential investor, they might find us from the oil and gas fund or real estate ad. And almost all the time they gravitate towards the credit fund because of how, just, what's the word? I guess,
Consistent.
consistent. Yeah, consistent it is. And it's the foundational piece of the portfolio. Um, but for those of you that are new to the fund, I think it's important to reiterate that what we're trying to do is to maximize yield while introducing the least amount of risk possible. If we take a look at the typical capital stack, on the right, the higher you are on the stack, the more risk you take and try to get the highest yield, but you're paid, last to get paid. The lower you go in the capital stack or a senior debt, you've been taking less risk, but typically you have a lower yield and first get it paid. Right there in the middle, that middle section, preferred equity, mezzanine debt, that middle section is where we are playing with the credit fund. It's where we're lending out. We're looking for current cash flow through lending of second position debt, preferred equity, giving us the option for a forced sale or takeover rights if the sponsor defaults or is not following obligations. And that's where we get priority payment, strong cash flows, and less risk. And guys, listen, we could not have picked a better partner to work with than Aspen Funds. Their edge is their focus, and they're operating in the non-institutional space. Deals that are just too small are too fast moving for big players. This means less competition, higher yields, just clean and efficient private credit backed by preferred equity, mezzanine debt over various different real estate assets across the U.S. And we're going to share, some of the additional or the new investments made in the credit fund the last quarter. There's been a lot of activity, or a lot of the activity early on in the year is starting to materialize now. But how does Aspen actually, make decisions? It's multi-layered. It starts with the development or developing relationships with capital markets, brokers, lenders, sponsors over a long period of time. I mean, Aspen's been doing this for 14 years. This results in a lot of deals in the inbox, which they say no to most of these deals. They're very conservative in their underwriting. If one passes the first pass sniff test, then it must go to the investment committee and be voted on to go to a term sheet. They run full extensive diligent process, negotiating process, and then they have to receive a unanimous vote and consent from the entire committee to move forward. And they're looking for sponsors with great track records, with, let's say, 5+ years experience, not just in real estate, but in that specific strategy, but also geographical area, and also stable deals with strong market and strategy thesis, and so on and so on. So where are we today? Since the last update, we've had 4 new investments. Actually, I say 4. I just talked to Aspen earlier. We're about to close on 2 more. So we could call it 6 new investments made this last quarter into the credit fund, puts us at 15 new investments. Deployed just over 40 million of capital. And again, with those 2 new assets closing, we'll be closer to about 50 million in deployed capital. What's crazy, Walker, you were talking about this the other day. What's crazy is we actually have to close this fund every quarter because of the inflows. This fund is so popular. We're trying to keep up with new investments into it because we don't want there to be too much cash drag on there. But it's so popular. The inflows are crazy that we actually have to close it down at a certain point each quarter and then reopen it.
We're pretty quiet about it.
Yeah, we don't really talk
Yeah.
about that much, do we?
No. No.
So So how's it split among the different asset types and debt?
Can I jump in? Can I jump in and just like
Yeah,
say one
yeah,
little thing on that, Mike? It's fine for it to be popular. It's just it has to match the consistent acquisition of new loans that we're making. So you have to keep it in line because otherwise you sacrifice, our share price as current investors. And so
that's right.
we can only bring in money as long as we're deploying it at an equal rate.
That's
Sorry to
right.
continue. Yeah.
No, that's good. Yeah, thank you.
So that's the constraint that limits our ability to just take it in. Keep going. Sorry.
That's right. Yep. So how's it split among asset type and debt use? We see here, no surprise, the majority of it, 47% is multifamily, and then industrial, student housing, which we actually just added a new investment in that. You'll see in just a second, and then medical office as well. And then the usage of the debt, purchase and development, eat up the chunk of it. So the rate decreases or has actually helped in that realm where there's more appetite, new appetite for new purchases, acquisitions, and also new development, and then about 14% in recap. So let's take a look at some of the new investments this past quarter, starting with the multifamily asset class. You'll see several different multifamily, starting with Springfield, Missouri, 2 multifamily properties. This is a new acquisition. There's a preferred equity deal. Cash flow day one at a 1.05x debt service coverage, stabilized debt service coverage at 1.2 plus, which tracks in their conservative underwriting. This is a repeat sponsor and property manager. Pro forma rents are already being achieved, and the kicker is they negotiated 4%. Aspen negotiated 4% equity kicker on this deal, and it's got limited capex risk. And then there's the next one in Victoria, Texas is a recap deal, no cash out, no capex risk. And this one going in debt service coverage above 1.2x combined. There's an in-place operator and property manager on this deal. It's 97% occupied already. And there's 25% equity cushion above our investment at stabilization. Lastly, this last multifamily deal, another acquisition, multifamily property in South Houston, cash flowing day one at 1.12x debt service coverage combined. Great sponsor track record. The sponsor has a track record in this area. Stabilized debt service cash coverage of 1.4x. That's a great number. And purchase below the seller's loan basis at $110,000 per unit, and 33% equity cushion above our investment at stabilization. So 3 new multifamily properties this quarter into the credit fund. And then we have the storage facility. So this is a new acquisition, a purpose-built, climate-controlled self-storage building in Lakeview, proven operator of self-storage in this market, purchased from a developer below replacement cost. This is an institutional property manager. CubeSmart is the property manager, no capex risk. Sale comps above 300 a square foot, pro forma exit valuation around 200 a square foot, then break even at just over 150 a square foot. Stabilized debt service coverage of 1.28x, and then stabilized debt yield of greater of 9.5%. So another really, really solid deal, new acquisition into the credit fund. This is the student housing deal that we talked about early on, just very quickly, in Spartanburg, South Carolina, my home state. This is a new acquisition, purpose-built student housing, cash flowing day one at 1.25x debt service coverage combined. Strong demand, only 1,000 campus beds, but over about 4,500 undergrads, and no new development. Specialized property manager. High current pay. This is 37% equity cushion above our investment at stabilization. Class A, a lot of great amenities in the student housing, walking distance to the university. This is verified. The sponsor liquidity is 17 million. Again, if you go back to the way Aspen underwrites what they're looking for liquidity and net worth for sponsors. They verified this sponsor has 17 million of liquidity, but also a net worth of 165 million, which is wild. And then stabilized debt of greater than 9%, break even at 124,000 a unit. Lastly, industrial development. This is a new development deal. And this is in El Paso, Texas. This is a ground-up development of 2 industrial buildings, receiving this. So into the fund, this is receiving 20% of the GP carry into our fund, 36% equity cushion above our investment at stabilization. 2 buildings. The combined square footage of the building is 636,000 square feet. Sale comps of the empty shells trading at 120 a square foot. Well positioned if lease up takes a little bit longer. Break even at 87 a square foot and stabilized debt yield at 10.53. I've had a lot of conversations. I've got conversations with many of you about, the foundational piece of your private market investment portfolio. So if you have not looked at BuildFlow yet, I strongly recommend you do. So, Walker, I'll turn it over to you, but, with that, how are we doing with Build Wealth? Can you give us a little snapshot of what that looks like right now?
Yeah, thanks. Guys, I want to throw this slide in kind of at the last minute, and it's because I think it really drives home part of what we're doing here. Please do not take this slide and run back to our partners at Aspen, because I'm just trying to show you exactly how much more money you make with us with the way that we approach it. And again, we had my guy from Goldman Sachs completely re-underwrite from scratch the entire portfolio. We love the assets. As you can see from Mike's overview, all of our loan to value ratios, total loan to value ratios, are very, very conservative. We've got takeover rights, and it's like if you look at like the ideal risk return profile of all assets ever, like this is it. And if you go all the way on the right hand side, you'll see retail class A. This is if you were to invest directly with Aspen, which is of course an option for any of you. In your year one, because of the fees that they charge in year one, even with a gross yield of, I think they're at 13 or something percent right now. I can't remember off the top of my head, but in year one as an LP investors, we get a 4.7 because it's front loaded on fees like that, right? And so in year one at BuildFlow at Build Wealth with us, the equivalent, the annualized return of someone who invested this year with us is 11.4%. Okay, except they did better. Because I'm in it as well. I'm the second largest investor in this fund of ours. We made 12.9%. And why is that? It's because, look, when we started this fund, I had chosen a company to handle the entire back end because of all of the movement of money. Like, guys, this compounds every month. And so if you happen to be one of the people that are cash flowing instead of compounding, you will make a little less money because the compounding, you'll get another percent probably over time. But ultimately, everyone who's cash flowing, the money, it's just like we get the books done and like more cash comes in. It's like this money machine. And so we left that company that I'd hired because I realized once we engaged, they had a extremely subpar investor interface that you guys were going to have to use, which was new information to me. And so they were like, no, we need all your investors to sign up on our platform. And I'm like, nope, I'm trying to centralize all of their experience, not have all these different places. So I fired them. And we brought it inside. And what happened was it actually fell on my desk. And I personally ran all the accounting for about 4 or 5 months. And the first thing I did was eliminate all fees, because until we had, an actual CPA, that we could back and support, you guys with confidence. Like, I'm not going to sit there and take fees. And by the way, when I say no fees, I mean no management fees. We do have the acquisition fee because that's what pays our sales team. So that's 1%. And when I say sales team, I'm just saying that's what Mike gets. So Mike has to eat too. So the point is there was no management fees being taken. So we actually ended up with 12.9% in our first year. Okay. If we continue to hold at exactly the same yield, at exactly the same debt rate. We are forecasting right now 13.7% cash on cash returns to our investors in 2026. Guys, that's no kidding. We're pushing 14%. I was talking to Ben Fraser yesterday, who's a partner on the board of this fund, and said, "Listen, we need to increase the leverage of the fund at 10%." And he was like, "I'm working on it. I'm working on it because we need to get it. It's dropping from about 7.5 to 6.6. I'm sorry, I don't want to get into the numbers too much, but ultimately, we get a better yield if we just have a little bit of debt. If we can just push it to 10%, we can get over like 14% cash on cash returns in our fund with fees, guys. So look, we're just talking about the exceptional returns that David Swenson got at Yale, and what was he getting? 13.7% average every single year over his tenure. I mean, this is such a great fund, and I think that we're also, and I think this is really important, we are playing under the market. So there's a lot of institutional buyers out there that, are going out and doing, 50, $100 million private credit loans or whatever, $20 million private credit loans. We're doing like, our average loan is like 3 million bucks. So we are below where all the institutions are playing, and we are above what normal, hard money lenders can actually do. And so we essentially have a monopoly on this whole entire market that we play in, and we focus on the Midwest, just like we do at AHM, because of the muted peaks and valleys and the increased consistency. So this thing compounds every single month. It's semi-liquid. I think it's a 2-year lockup. And so it's a great place. And just to share, I've dumped hundreds of thousands of dollars into this fund this year, and it's I absolutely love it. So, Mike, do you want to stop sharing your screen and we'll move over
Sure.
to me? Did I forget anything there? Did we hit?
No,
Did we hit? Did we hit
I
it?
think I think we hit it.
We
Hit it all.
got it.
Yep.
Okay, yeah,
Great.
yeah. So it's all yeah. We'll leave it at that. In other words, this is what I want to say. One more thing, guys. I think a lot of times, the credit fund, it's not as attractive. Like you look at, OK Stone, or you look at the 314, or you look at, effing James Bond, for crying out loud, and it's like, well, I want to be in that sexy stuff, and we do, we do, um, but I mean, the thing with a credit fund is that if you compare this to the stock market, like you're not going to sell out of the stock market. That's crazy. Like don't sell 100% of your stock market holdings and put it all into Delphi. Like as attractive as that seems, it's also irresponsible. And so part of what we need to do is diversify, right? And what you want is, overall to have a portfolio that is cash flowing and appreciating. And you always want to have between 12 and 24, or work towards having between 12 and 24 private holdings in your portfolio, because that's where you optimize diversification, which optimizes safety. And once you're in this fund, you will love it as much as I do, I promise. BuildLegacy. Okay, let's keep going. So BuildLegacy was our newest fund. Let's see, do I have this is the largest populated neighborhood in downtown St. Louis, guys. This is, look, I could talk forever about the Central West End. It's like maybe one of the most, it's like maybe the second most in-demand neighborhood in the entire Midwest. I know it's a big claim, but whatever. There's billions of GDP coming out of this. It's a higher than average educated, higher than average income neighborhood, and our fund, is acquiring 11 what we call seed properties right at the beginning, and then expanding from there on a full 10-year hold. Okay, and so this is just an overview of the 11 initial seed properties, and we are going to own all four corners of, one of the it's either the number one or number two intersection in the neighborhood. If you measure foot traffic, it's technically number one, because we have all of the restaurants. And so, oh, whoops, that's a stone. Sorry, that's a stone. Let's see if I have okay, sorry guys. My updates for this, I bet you the slide is somewhere else in here. So we have secured our lender. Let's see if I can get a better. Let's do this. We've secured a lender, and we are closing by the end of the month. Kyle is hoping that we can close before Christmas, or sorry, before Thanksgiving, so that, quote, we all have something to be thankful for. There was just some delays in all of the, the third party, we had slow third parties involved with, the appraisals and, whatever. But it's a very attractive portfolio to a lot of lenders, which I won't go into here. Number two, the very slight delay in closing on the 11 properties by the slow third parties, it worked 100% in our benefit because occupancy actually increased 13%. When we initially went under contract and we brought it out, occupancy was at 70%. Today it is at 93%. We also have, I can't say because we're under NDA, but we have another commercial company going in and taking, I believe, the last commercial property that we have. Number three is our new pipeline of expansion opportunities continues to increase. So just last week, I got an opportunity to buy two more condos in Euclid East, and also we toured another proprietary sourced building that would work really well. We kind of hinted that we have other buildings that are essentially touching our buildings that are ready to sell to us as we continue to expand this portfolio, and that is true. The one thing that I want to kind of remind you on the projections of this deal is that all of the projections were actually just on the initial seed properties. Okay. I love this fund. And the reason why is because it's a completely diversified fund in terms of number of properties. And the second we close on our 11 seed properties, we are the largest owner of real estate by property count in the Central West End, period. Okay. We own 900 apartments already in downtown St. Louis. So we continue to increase, our edge and our information that's in there. This forecast that I'm sharing right now is only underwriting the initial 11 seed properties. We are acquiring, just as an example, the single last 1 acre lot that would allow for ground up construction in in Central West End. Okay. So, we're going to be co-GPs on that project over, whenever we decide to move forward and build that. But the point is to use the cash in the fund to continue to acquire more buildings before we start cash flowing. And so the internal equity value actually increases extremely significantly to the point that, by year 6, we're all making, 20% cash on cash returns. As we work towards an eventual exit around year 10 or slightly thereafter. And you'll see that right here, I just sort of, again, compared it to the stock market because it's important that every time that we're looking at what it is we're trying to do, like, let's just remind ourselves, what are we doing? We are looking for outsized returns by capturing supply-demand imbalance. And there's huge demand for luxury apartments in the Central West End that continues. So, very exciting project. I think that the big point here is this is a $10 million fund. The first $5 million was raised and so we have another year or so. So we're going to leave this fund open and just continue to raise. And the original projections, these are not only on the original 11 seed properties, but it's also based on the 10% preferred return that is currently being offered. So I know that everyone that came in before we acquired the 11 seed properties got a bonus 12% preferred return rather than a 10. But the point is that literally was just extra juice. Okay. This is at 10%, still an absolutely fabulous fund that is very near and dear to my heart and a very easy turnkey way to walk into an entire real estate portfolio that could ultimately just be, the real estate portion of your retirement if you wanted to go that way. Guys, I wanted to share a side note. I think, like everyone who's an investor knows me and is probably paying attention to things I'm doing, but I wanted to put a little bit of color on this. Acquisition Lab was the company that Chelsea Wood and I started 5 years ago to help mostly, readers of Buy Then Build buy existing companies. And my goal was to create the Y Combinator in the small business acquisition space. We effectively did that. We are the hardest to get into. We have the best results by a amazing amount, multiples of almost 10x higher than number 2 in the space. Okay, and way more than, I think we're like 37x higher than number 3 in the space just for our results. But the point is we recently merged with Shareholder Ventures. Okay, and if you're on this call, you're an investor and you know that there's no such thing as a merger. Someone bought somebody else. And I sold my company to Shareholder Ventures, but I'm very much involved. I'm still running the lab. Chelsea is still running the lab. I'm a owner in, I have equity in the Shareholder Ventures holding company that owns Acquisition Lab. I'm an investor in the Shareholder Ventures Fund, and I am a venture partner on the board of the Shareholder Ventures Fund. I'm also on the board of the holding company. I'm very involved, okay? And here's the deal, is that Shareholder Ventures provides capital to entrepreneurs who are looking to buy small businesses by elevating what they can buy. They'll find a Mike Brown and they'll say, Mike, you worked at Broadcom and ran all this other stuff and you are like awesome. And, just because you only have $5 to invest in buying a business, let's go ahead and change that and make it $1 million in cash to buy a business. And so, you can go out and buy a company that is equivalent to your capability. Okay. And, I only said you had $5 because that's all you've made on the credit fund acquisition fee. But I'm kidding. But it's like the point is like, here's what I want to share with you. If you want to play, if you're like, I read Buy Then Build Walker, I'm looking for that game, okay, and you want to get into that, like, I don't know a better way to play that Main Street acquisition entrepreneur investment play other than with the Acquisition Lab Shareholder Ventures move. This is something that, I have a lot of faith in, but, there's kind of a firewall between what we're doing at Build Wealth and what I'm doing at Acquisition Lab. And what I mean by that is just because I'm a venture partner on the fund, just because I am an investor in the fund, and just because I own some equity in Acquisition Lab, it does not mean I have any control or any decision process over any of the businesses or entrepreneurs that we're backing. Okay. This is not a Walker Dival fund. Okay. It is a partnership that was formed in order to help Acquisition Lab members elevate and acquire what they want to do. Okay. So I just want to be clear about that. I think it's a great investment. I invested in it myself. Quite frankly, a small amount, not nearly as much as I'm putting into our Build Wealth projects. But it's, this play is there for you. You're invited to come along. Write me at Walker at Buy Then Build if you want an intro, and I'll get you over to the guys and we can make that happen. If you do want to invest in that, also make sure you tell Mike Brown here, because I want you to review all of the options and make sure that we have the best one for you. Okay. Okay, we are at 1 hour. Okay, awesome. We're going to keep going, guys. We've got, I think, if I remember correctly, we're just going to talk about BuildEnergy, and then we're going to talk about our new fund, and that's it. Okay. So with BuildEnergy, what I want to start with is, we've raised just shy of $5 million in this fund. We've got some amazing updates for you. BuildFlow I, our credit fund, is the highest risk return profile I've ever seen in any investment ever, including the stock market and treasuries and all the rest of it, period. It is the most underrated fund that we have. BuildEnergy, outside of my $1 million commitment, okay, to joining the partnership at AHM in order to secure all of their deal flow for us, my largest investment this year is in BuildEnergy I. And my largest investment 2 years ago was in Mahajar's last fund prior to this. I am a huge believer in this fund and the returns that it outputs. So, again, forgive me if it sounds like I'm selling. I'm just trying to draw your attention to the fact that, like, if you're not in this fund, you should really look at it. Because I feel very strongly about it. And a lot of it is, the supply demand imbalance. And let me say it like this, all empirical evidence supports the fact that this fund is just going to absolutely crush. Okay. Remember that disclaimer at the beginning. I can't say that kind of stuff. But, ultimately, just, hear me out. And again, we've done a whole pitch on this. Like, you can go in and look at it. I'm not going to beat this to death, but I just want to kind of remind us, what is the play that we're doing? Okay. Basically, 83% of all energy comes from fossil fuels. No matter how, green we want to be, it's all coming from, oil, gas. Like, here's the same thing, the same chart, just to put it in perspective. Oil and gas is absolutely enormous. Okay. And this is just current levels. And it's growing. It's expected to grow our demand of energy is expected to grow by 80% by 2050. Okay. So it's huge. And it's growing. Okay, that's the point of those two slides. The next slide is that we're going to say that, Oil and gas, even with renewables, okay, are expected to continue to make up over half of the world's energy mix by 2050, which is not next year. It's not 5 years out. It's a long way out. Okay, this is a long change because oil wells decrease over time. An individual oil well is actually a depreciating asset because it has a limit to how much oil you can actually extract out of it. Okay. So we need new resources and projects in order to continue to meet demand. However, there's been a collapse in private equity funding. And from the 2013 to 2017, when compared to 2018 through 2023, you actually have an 81% decrease in private equity moving into it. Okay. And this just changed in this last year as people are more and more moving back into this space because they're seeing the same thing we are. Okay. So, real quick, I don't want to beat this to death, but basically, you can peg, okay, a oil to GDP growth, okay, and it ends up looking like this, okay, so that you've got every every zero point 0.9 barrel of oil in 1970 matched $1 of or $1,000 of GDP, and today it's 0.04. So it's becoming more efficient. But the point of this is just to geek out for a second, is just to explain to you that it's extremely predictable. It's extremely predictable to understand how much oil we're going to need for GDP and how much demand there's going to be. And as a result, the powers that be, which is not on this slide, I forget who gave this. I should have quoted that. I apologize. This is like BlackRock, I think, or something. It's in my proper presentation.
I think it's JP.
JP, great. We have a immense supply constraint. Okay, we do not have enough oil and gas to hit demand, and there is going to be an immense shortage in the midterm. Okay, so we already are underway an energy crisis. Okay, it just is so far away that we can't see it yet. And so if we just sort of pause and say, well, what is Warren Buffett doing? Well, this came out like 1 month ago today. Warren Buffett is getting into oil and gas. Okay, we've got Warren Buffett, we've got Abu Dhabi, we've got Blackstone, we've got KKR, Canadian pension funds and sovereign wealth capital, Apollo, like all of the big money is now starting to pour back into this because they are looking at the same things that we are. Okay, and ultimately we've got these short-term drivers that are out of sync with the midterm demand that's there. Okay, and that's what's driving oil prices low right now. So we've partnered with Mahajer Energy Advisors, Jeff Mahajer and Mahajer Energy Advisors. And when you actually look at his track record over multiple decades, you're talking about, no kidding, an average of 50% internal rate of return. Okay. And so when you look at our other partners are Aspen, right? Those are our capital partners. And when you look at their offering on this fund, you get all of these options. And I just want to draw your attention to, here's us. Okay, we are right over here with the family office. All right, your minimum investment is 50,000. It's not 5 million. It's not 250 or 150. Okay, we've got a share price discount of 15% rather than 5. We've got a target annual return of basically 30% instead of 27, 28. And we've got a net IRR of 30% instead of 27, 28. This is again, if you like to make more money, you should go with us. That's just, and again, don't tell Aspen, but this is what we're doing as a group. I'm getting in, I'm doing more diligence, and working, and we're getting these family office deals. So, I'm more of like a super LP or a representative LP of all of us in these deals. And some of them I'm more of a GP or a negotiator. For example, with 007, Delphi, I was the very first check in. My dad and I were the very first checks in back when they got the 007 license. This is BuildEnergy I. This is the pro forma base case. There's also a stress test case in there if you want to jump into the situation. And so ultimately, you can see that the cash flow is extremely healthy, and you can see that the multiple is extremely healthy. Look, some people get into oil and gas because they want immediate tax write-offs. That is not BuildEnergy I. BuildEnergy I is all about, I want tax efficient cash flow and a big pop at the end. And so ultimately, we're reinvesting the cash flow the tax efficient cash flow inside the fund in order to acquire more oil wells. And so we're actually increasing at a rate that's significantly faster than the rate in which the oil wells decrease. And so we are, we're basically building a buy then build style portfolio of cash flowing oil wells and growing them organically through infill drilling. Here are the updates. We did 2 offset wells at Powder River Basin, which is in Wyoming and Montana, which is just becoming sort of Jeff Mahajer's new love. The Permian Basin is the name that we all know and love. Things are, expensive, it's crowded, all the rest of it. And it's starting to, I don't want to say that because I don't want to get called out for saying something partially wrong. So whatever. Point is, Mahajer loves it, and this is where he's spending a lot of his time right now. We've partnered with Devon Oil, who is running them. But here's the thing: we were offsetting the wells off of their highest producing well in the entire basin to date. Okay, and both of those came online in September, and production is slightly above target on both models. So we're projecting a gross internal rate of return at 25%. On those wells that we have, even at current oil prices. So imagine what happens when they go up. We have 92 producing wells already under contract right now that we're going to close for $7.25 million at a 20% discount and NPV. And so we're trying to get at 15% discount NPV. We're getting a 20% discount NPV, and we do not have to pay for the proven but undeveloped producing well sites. So the cost of oil is low, which means that we are able to get all of these at a low price, and we're getting them at higher discount rates than we're targeting, and we're getting the proven oil land for infill drilling at no charge included in the transaction. Okay, so that whole like buy low, sell high thing, this is the buy low part. That whole like buy when there's blood in the streets, that's this part. Like this is the part where it's like, really guys, isn't oil down? Yeah, oil's down, and we want it to stay down for another 6 to 12 months, and then we want it to go really high up, which over the next 5 years, I'm gonna predict it right now on this record line. We will hit $100 oil at least 2 times in the next 5 years. That's my personal projection. Hold nothing to that. I'm probably drinking too much of this watermelon water. But anyway, the point is like, we've got 3 deals in pipeline ranging between 15 million and 40 million. Target fund size is 75 to 100 million in equity, 125 million in buying power. I'm just going to tell you, I'm in the room, and I know that that's a little light. We should. I think that we're secretly going to end up with more buying power than that. But things are looking good on all of these fronts is the point, and that's kind of where we are with that. And I think the other thing to mention is, I said the tax efficient cash flow which is in the fund, which is true because we get all the tax benefits in the fund to buy more wells, right? We're compounding all of those gains to buy more wells. But when the money comes back to us as LPs, it's extremely tax efficient dollars because there's so much, getting written off with inside the fund that, we get the benefit of all of that. I mentioned all this. So basically, like, yes, oil is low, and we want it to be low because we are like buying everything that we possibly can. This is the big one. I believe that BuildEnergy I should actually be our largest fund of 2025 because I believe in the thesis, I believe in the returns, and also we can raise that much. Like if I could raise 10 million for 007 and Delphi, we would have. Like, Mike, we would have done that in probably a month. Yeah. I mean, that just went right.
Right.
And I shouldn't say this, but we might have a special surprise in 2026 around that point. But anyway, let's not go there. The point is that we can raise up to $10 million in BuildEnergy I. I just met with Aspen again last week or 2 weeks ago and negotiated an increase in our allocation. And so they would like that because it reduces the amount that they need at the end. I am one of the largest investors in this fund right now. I am personally investing more in this fund before it closes. Our partners at Aspen have already invested hundreds of thousands of dollars, and if it follows what they did last time, they will end up putting millions of dollars of their own money in. And Mahajer on the last fund put in $6 million of his own money. And when I say his, I shouldn't refer that just to Jeff. It's the Mahajer Energy management team. So all of us are, kind of backing the truck up, so to speak, and investing in this fund. And again, if you invest in our version at BuildEnergy I, you will make more money than any other possible avenue to do it. Anything else before I move on, Mike? Are we good?
Closing it December 23rd.
That's where I was going. Sorry. We're
Really
closing
important.
December 23rd.
Yes.
It's a hard close. Why is it a hard close? Because for tax reasons, if your wire doesn't hit our account before December 31st, we cannot accept it. We're sending it back because because for tax reasons. So we have to have all wires in process going into the Christmas weekend because we need all of those wires to hit the following week, and we cannot receive any money after that. This is a very hard close. And so we've got about, let's just call it about $5 million in allocation left. And I do plan to talk about this a lot over the next 90 days because I have a lot of faith in it. And as you can see, a lot of what we've done is anchor in real assets, meaning real estate, highly collateralized private credit and, oil and gas. So, yeah.
So for anyone on the call that's not in Energy One and is interested, or you got friends or family or anyone that might be interested, reach out to me, set up a call. That is a hard deadline. So let's just get on a call as quickly as possible.
Yep. Awesome. Okay. Cool. Our next fund. Can you guess what it is? BuildEnergy II. Now check it out. This is a very, very different flavor. Okay. And I plan to open one of these every single year in October, November. Okay. And I'm just going to tell you before I even go into this, guys, this fund is open for 1 month. It's open for 1 month, and we will open it again next year. Different. It'll be BuildEnergy, whatever, 3 or whatever. But the point is I want to bring one of these out every month. Why? Because it is an 80 to 90% active income write-off. Okay. If you don't want to pay taxes this year, this is your move. If you want an investment where you're going to get a 2 to 3 times your actual money, but get an 80 to 90% write-off this year on active income, BuildEnergy II is what that is for. This is a depreciation sink for all of us that don't want to pay taxes. What is it, Walker? This is a diversified U.S. domestic drilling fund. We are buying, again, cash flowing oil wells between 50 and 100. It's a $100 million fund. We've partnered with someone that I've known for a couple of years. We've done extensive diligence on this person, and we're going to formally launch this next week. Okay. And so there'll be a whole presentation. You can meet the GP with me on our partners in the fund and all of this and where we're getting all the stuff, and you'll get the whole story. But ultimately, we're buying a maximum of 10% interest per well. We are targeting 35 to 40% price per barrel break even. Okay. So we're looking at people that are making money at extremely low oil prices. We have geographical diversification across 5 basins. We're partnering with the top operators in the space. We've got non-working interest participation, and we've got transparent investor-friendly structure. It's front-loaded tax write-offs with monthly income with strong tax advantages. It's really quarterly income will be the payments, and so we've got 80 to 90% tax write-offs on active income, guys. This can be capital gains, it can be earned income, it can be anything that you want, and that's what's so unique about it. There's a 2 to 3x multiple on your money, okay, projected. We've got 24 to 30 months to return the capital you invest. If you invest $100,000, let's just say you made whatever $400,000 this year. Well, guess what? You're going to invest $400,000 into this fund, and now your tax bill will be like 20 grand. Right. And then we are going to give you back your $400,000 in the first 24 to 30 months of this fund. It's a 7-year hold. So you can do the math there. The first, 2.5 years, you get your money back. And then there's another 5 years where you just continue to get checks every single quarter as this goes out. And basically the internal rate of return, once you start including the tax write-offs in your return, it's north of 30%, but I like to think of it as I don't like to do investments just for the tax write-offs. I want to know, is it a good investment where I'm going to make money? This is not like exploratory, offshore drilling. This is literally the same thing we just talked about. We are buying cash flowing oil producing wells, and writing them down. Okay, and we're getting write-offs on the thing, and then we're just writing them to depletion, or we will sell them in year 7 for a final bump if we want. And so that's the kind of thing there. And so we're partnering with the biggest operators in the space. Okay. You know all these names. These are the people. And, we're taking small non-working interest while they go out and, invest in a lot of these wells and producing them. We've already closed on the first 8 wells in the Colorado 8 package. And this whole thing is underwritten at 600 million. Let's see what's so here you'll see the 600 to 1 million EUR estimated recovery. This whole entire fund is underwritten at 600. Okay, and so we are already estimating that even just the first Colorado 8 package is it should outproduce even our low underwritten model. So it's very conservatively underwritten. That's obviously on purpose because I don't ever want to tell you guys that like we didn't hit any estimates. So we're trying to do that, and so I'm very, very comfortable with how this is underwritten. You can write off any of these types of gains, and here's why. We'll go into all of this next week, and just a repeat of what we've done. So I think the point is like if you are interested in this, what I need you to do is please reach out to Mike Brown right now. We're going to talk about looking ahead in a second. I want to give you Mike Brown's email and phone number. We will have this up for soft commitments maybe as early as today. I mean, we got to talk to Lauren. Lauren's in Bora Bora at the moment. Hi, Lauren. But so we don't have the page up just yet for soft commitments, and it's not fully complete until we actually have the webinar and everything, which don't hold me to it, but we're targeting Tuesday of next week. If you're interested in this, please get with Mike. It's a very short window, and we want to make sure that if you don't want to pay taxes, that you get in. Okay. Does that sound right? What did I miss, Mike?
You hit it all. We're good.
Okay, cool. So here's what I want to talk about in terms of what we're doing as we look ahead. Okay. Number one, we are going to continue to work with our A-team sponsors that we've partnered with. Okay, you should see more deals with Aspen funds. You should see more deals with AHM, and other partners that we've already been able to diligence. And our BuildEnergy II partners will have another one at the end of next year. I want to do that for you guys. And and number two, we are looking at more private equity investments. Okay, so again, look, I'm the buying businesses guy. So why am I bringing, credit funds, real estate, and oil to you guys? Because I think that, businesses tend to be slightly harder to underwrite. And the way that you get into better business opportunities, better private equity opportunities, is you come to the table as a capital provider. And I want you to know that what we have done over the last, 14, 16 months together is proven that, when we bring a deal out, we can raise, $5 million in, 4 to 6 to 8 weeks, right? And so it's one of those where as long as there's continuing interest to do that, we are getting seats at the table. Moreover, I'm going to share my thoughts right now, which I shouldn't necessarily do because they're not fully formed. But the thing is that when you buy businesses, you really you shouldn't buy like one business. You should be doing like entire portfolios of higher EBITDA generating businesses with existing management teams that have playbooks, the same style of thing that we're looking with like Mahajer, for example. So, I want to be able to get to a point where we're actually able to like kind of underwrite the sponsor of the deal. And it's a deal that we know and like and capitalizes on those supply demand imbalances. And so as a result, I have a lot of interest from institutional people that want to also back us. My first goal is to bring everything we're doing to you guys. I want more than anything to build a community of everyday accredited investors where we can get access to deals that we didn't previously have. And I want to do it with superior terms and superior diligence and superior access. So the way I'm thinking about this is we've been syndicating by deal, right? Other than the BuildLegacy Fund, everything we're doing is by deal. As we move into businesses, I think what you're going to see from us is more of a fund-like approach where we are raising a bigger amount of money over a longer period of time and then acquiring multiple companies inside that portfolio. Okay, I've got a number of conversations happening right now. And so we've built the base. We've got the credit fund, we've got the real estate, we've got the oil and gas, we've got a few pops on the top with Stone and Delphi, right? And we've got some of these private equity that's been getting in there into our wealth stack. And so what I want to do is I want to start to solve for that private equity piece because all of us kind of want it. And so all of this has not only been stepping stones for your own portfolio, it's also been stepping stones for the whole Build Wealth community and the things that we're able to bring to you. Okay. And so a lot of that has already started and it's underway. Next is when I built Acquisition Lab, the question I asked was, look, if I took a course on, buying businesses at Harvard or Stanford or another Ivy League school, what would that curriculum look like? And now I'm asking myself, if I were an LP investor wanting to get into the private markets, right? Like what would that education look like? What would that course look like? And so what I did the last time was I hired a accredited curriculum consultant and, we built out all this stuff and then I actually taught it at a university for a while. And I'm not going to do all of that kind of proof of concept this time. But the thing is like, I'm going to drill down and figure out what is the education that we all need and how do we extract that? Okay. Moreover, I really want to focus on pulling us together as a community. Also, one of the lessons I learned from Acquisition Lab is that when I do meetups at any city and we all come together, it's like the most fun I've ever had, right? And as you look at the slide of where all of us are living, I'm thinking, we've been thinking to ourselves, should we be doing some kind of, pull this education together and potentially do, a roadshow? Should we be doing meetups, right? Should we be doing investor education at all of these, big circles? And these are the things that are very, very interesting to us in terms of how do we build community, how do we build tools, how do we build education, and really power ourselves as investors so that we can, have fun, do awesome projects, and stack cash, which is, what I want to do. If you want to get involved with helping us host a meetup, in your city, please reach out and let us know. Because if you're volunteering, you're probably going to be the first place that we go. Okay. So, if you want to be boots on the ground and assist, that would be amazing. The other thing is I want to know what you want. Do you want to see more private equity? Do you want more, whatever. I want to know what it is that you want, because these are all things that we can execute on. And what kind of deals do you want? What kind of things do you want from us? And also, ultimately our goal is to help everybody who can to sort of like take control of their financial journey and, get through that bridge from the 2 million in net worth to 20 million plus in net worth together. Mike, that's all I have.
There's a lot of people already saying, I want to host the event here. So
nice. Let's go.
thank
Let's
you to
go.
everyone who's texting me right now. It's
Let's
going to
do
be
it.
fun.
Yeah.
It's going to be a blast.
Yeah. Listen, guys, I did not expect this to go 90 minutes. It's all Mike's fault. He talked way too long. But thank you so much for being a part of our community. Thank you for putting your faith in us. Thank you for allowing Mike and I to live our highest and best use. And I really look forward to seeing all of you in person in 2026 and all of the exciting things that we're going to be able to bring out. Let us know how we can help, and we'll see you soon.